Okay, friends, chalo. Right, friends, so welcome to day 2 of the revision marathon of CA Intercosting by none other than me, of course, Prasanna Kumar. So, one important thing before we start with the session is that, as I told you, material will be available in my Telegram channel. I already told you the same, and the Telegram channel name is PK Sir Classes. So, without any gap, you just search with this name in the Telegram channel, you'll get the class. In that, already I've shared PDF file. And it is obviously password protected. Okay, so the password for that PDF file is 924694644. This is our PK Sir classes number. This is a number for your inquiry and all the other things. You got the point. So 924694644 is the number for PK Sir classes, and that will be your password for this particular material. You just download the material and voila, this is your material. Okay, so you have all the chapters over here. Certain chapters will, like ABC, it will not be there, activity based costing, and that will try to do it from the study material itself. Is it clear? So, and whenever I feel, in addition to this material, if there is any one good sum in your ICA study material, then we'll be doing some straight away from the material. So I will take the decisions depending upon the situation. ICA study material, anyway you people will have it, so therefore specifically I need not give you a material with respect to the questions from ICA study material. Okay, whereas this material is necessary, therefore I gave you this. You got the point. I hope it's clear. Anyway, I think in the last session we are done with the first one and the second one. Also we are done with some good concepts, right? Break-even point we have covered, PV ratio we have covered, margin of safety we have covered. We have covered decent number of concepts. Okay, so now we're gonna go with question number 3. Okay, so I hope I gave you all the basic details, and before I get to this second session, day 2, first of all I want to thank you guys. I thank all the students who have specifically commented for the day 1 lecture. In fact, I personally felt very happy for all of you guys. So before we get to this session, I just want to thank you guys, because it's all about your likes and the comments that will help us. It first of all gives us happiness. Apart from that, it helps the YouTube algorithm to reach more number of people. So there is one comment from Priyanka. A quick revision of concept, sir. I need to tell you that each and every faculty uses different approach to a problem, but you have approached the formula in a different manner, sir, with the conceptual base. Thanks a lot, sir. Thank you so much, ma. And Trina Srivatsava, thank you, sir, for the concepts. Do upload more lectures, definitely. And Taraka Siddhartha, superb, sir, simply superb. Please continue this. Thank you so much, guys. And Abhijit, sir, please make it a comprehensive class and try to cover entire syllabus. We'll try to make it best, Nana, because obviously what we cover in 150 to 180 hours, I think it's to cover entire thing is very difficult in 28 to 30 hours, but still we'll try to do it 25 to 30 hours. Okay, we'll try to do whatever the best I can within the given time limit. Nishank, thanks a lot, sir. This was very helpful, great understanding and crystal clear concepts. Thank you. Shivanandu, sir, please upload the material in Telegram channel. I think now I've uploaded, guys. I think you can download it now. Sahil Bansali, awesome, sir. Please continue this. Got the concepts clear at one go. Simply awesome. Thank you. Manikanta Mungi, hello, sir. Yeah, with respect to the notes, you can find it, Nana. Now it has been uploaded. And Fairy Wanderla, sir, thank you so much for such amazing video. Got good clarity on marginal costing. And sir, one more session from my end. You please give one sum as homework and a test. We'll try. That could be even more beneficial for us. Definitely we'll look into that. Yeah. Rajat Kumar, thank you so much, sir. Thank you, Rajat. NLC, thank you, sir, for such a wonderful session. Thank you. Shivani, very much helpful. Thank you, sir. Thank you. Ajay Ayyappa Komineni, that was amazing, sir. Thank you. As usual, again, you are the best. Siddharth Bonapale, thank you, buddy. Manuel Royson, thank you, sir. Thank you. Sunny Sanu, thank you, sir. Thank you, buddy. Suhail, thank you, sir. Please add more problems. Definitely. Shivani Chaurashia, thank you, sir. Thank you so much, guys, for all your wonderful comments, and many of you have participated in the live chat as well. So thank you so much. Anand, Sushil, Chandana, Ram Krishna, Priyanka, Kapil. So thank you so much, guys. Dinesh Kumar. So yeah. So we don't have time to go through each and everything, but I thank all these guys and all the people who have watched, and thank you so much. See, ultimately it's all your support, right? See, by looking at it, it really gives us happiness. So we'll work late nights and all that stuff only to ensure that we can do that little bit of help from our side so that you can write your exams well and get the exemption. And that's our target of this particular revision marathon, right? So do the same, guys. Just show the same love that you have shown already in the first day, and definitely it's like an energy for us. So that will push me a lot to do more sums, to cover more, to make more videos. It's as simple as that. After all, I'm also a human being, right? So filled with emotions. So thank you so much, guys. Let's get to day 2 now. So now we're gonna go with illustration 3, and whenever there is a necessity of concepts, then and there we'll cover. That's how our strategy is going to be when it comes to revision session. Okay, so a company producing a single article sells it at 20 each. Okay, selling price is 20, marginal cost is at 12 each, fixed cost is 9,000 per quarter. You are required to calculate for the year the following: PV ratio, break-even sales in value, which means in rupees, break-even sales in units, sales required to earn a profit of 12,000, profit at sales of rupees 2 lakhs, margin of safety for 4 and 5 above. Okay, fine. Now before we try to solve this particular sum, you need to understand one thing. Marginal cost of production is 12 rupees. What do you mean by that? It is nothing but variable cost. So which means variable cost is 12. From this, which means, are you trying to understand that marginal cost and variable cost is nothing but the same? No. See, variable cost, it changes proportionately along with the output. That is variable cost. The marginal cost is not something that changes proportionately along with the output. Please try to understand. So we cannot say that marginal cost is always equals to variable cost. I'll tell you what is marginal cost. So marginal cost means anything that changes is marginal cost. What do you mean by that? Sometimes fixed cost also will change, sometimes at particular levels, and variable cost anyway it changes. When fixed cost is also changing and variable cost anyway it changes, then both put together will be referred as marginal cost, because marginal cost is anything that changes, whereas variable cost is only variable cost. Are you able to understand? Suppose in a situation where fixed cost is not changing and fixed cost is constant and only variable cost is changing, in that case variable cost is nothing but marginal cost. So when fixed cost is not changing and the only thing that is changing is variable cost, then variable cost is nothing but marginal cost. But when fixed cost and variable cost, both of them changes, then both of them put together is marginal cost, whereas only variable cost is variable cost. You got the point? That's one thing you should be clear. Okay, fixed cost is given 9,000 per quarter. You're required to calculate the following for the year. Okay, fixed cost is given per quarter. Right, I hope everything is ready. So let's start solving. Chalo. So now it is question number 3. Right, guys, so keep the material with you. I'm seeing the material here from another monitor. Let me adjust it. Just a second. Okay, it's fine. Okay, so first of all, let's have a look into the selling price. So selling price per unit is how much? 20 minus marginal cost per unit. We can also call it as variable cost, which is how much? 12. So selling price minus variable cost or marginal cost is nothing but contribution, which is 8. Correct? Anything else? Yeah, fixed cost per year is equal to, per quarter it is 9,000, correct, into 4 quarters per year. That implies 9,000 into 4. So obviously it's gonna be how much? 36,000. Okay. So 36,000 is your fixed cost per year. Okay, what else? That's it. So you're required to calculate the following. Now one by one, let's do the calculation. First one, PV ratio. Okay, PV ratio is equal to, it is nothing but contribution percentage. Moreover, we know the formula. What is that? Contribution by selling price into 100. That implies, what is your contribution over here? 8 divided by, what is your selling price, Nana? 20 into 100. So that implies 8 divided by 20 into 100. So it comes around 40%. Okay. So PV ratio is how much? 40%. Okay, right. Let's move on to the next one. What is the next one? He has asked BEP, break-even sales in value. In value is nothing but in rupees. Okay, nothing much to think over here. In value is nothing but in rupees. So obviously what's going to happen? It is fixed cost divided by, if I want answer in rupees, I cannot divide it with contribution per unit. Instead, I have to divide it with contribution percentage. Contribution percentage is nothing but what, Nana? PV ratio. That implies, what is your fixed cost per year? Just now we have calculated 36,000, all divided by PV ratio. Also just now we have calculated. How much is that? 40%. That implies, so 36,000 divided by 40%, which comes around 90,000. You got the point? So 90,000 is the answer. Okay, 90,000 rupees is the BEP in value. Okay, chalo, moving on to the next one. Third. So what else you have got? BEP in units. Okay. So now he wants us to find BEP in units, which means BEP in volume. Okay, so what is the formula? We are already aware of it. Fixed cost divided by contribution per unit. See, when it comes to marginal costing, you can do it in any number of ways. For example, you can use the typical formula to find break-even point in terms of number of units, or already BEP in rupee sales. You can just divide it with selling price per unit, which is 90. You'll get the 20, I think so, selling price per unit. You'll get the same answer anyway, right? So fixed cost is how much? 36,000 divided by your contribution per unit. Here we have calculated, which is 8. So that implies 36,000 divided by 8, 4,500 units. Or what you can do is that you have the total sales, which is 90,000, divided by selling price per unit is 20. In that case also you'll be getting the same number of units, which is 90,000 divided by 20, 4,500 units. So whichever way that you are comfortable with, you can do it. When it comes to marginal costing, there is no hard and fast rule. There is no fixed format. Please try to understand this. So normally I have done it with the help of formula. You guys can do either way. So here already sales is there, which is 90,000. So sales divided by selling price per unit will give you a number of units. Or you can use typical formula, which is fixed cost divided by contribution per unit. Ho gaya. Right. So after that, fourth one, what is the next one we have? Sales required to earn a profit of 12,000. So you need to find required sales. The condition is you need to earn a profit of how much? 12,000. Now, again, I see students, they again tend to by heart the formula over here. No, don't by heart the formula. Use your common sense. Now, you need to find out the sales at which you will earn a profit of 12,000. That is what he has asked you, correct? Now, tell me one thing. When you will start earning profit? Only after recovering fixed cost, correct? Once you recovered your entire fixed cost, then you will achieve your break-even point. After achieving break-even point only, you will start earning profits, correct? So which means, logically speaking, when I have to earn a profit of 12,000, first I need to earn fixed cost. Then only I can start earning profit. So which means your fixed cost is how much? We have calculated just now, it is 36,000. In addition to fixed cost, you need to earn what? Profit, which is how much? 12,000. So fixed cost plus profit is nothing but what? Contribution. So I can say this is nothing but required contribution. So if I need to earn a profit of 12,000, I need to earn 12,000 only after earning fixed cost. So fixed cost is 36,000. So 36,000 plus 12,000 is nothing but contribution. This is the required contribution that I have to earn. So from this, I can easily calculate required sales. How? Required sales is nothing but required contribution divided by contribution percentage, correct? Are you able to understand? Pretty simple. So required contribution divided by contribution percentage will give you sales. Required contribution is nothing but fixed cost plus profit, which is 36,000 plus 12,000, which is 48,000, divided by contribution percentage is nothing but PV ratio. So what is PV ratio over here? Just now we have calculated, which is 40%. Got it? That implies, so 48,000 divided by 40%, which is 1,20,000. You got it, guys? That's it. That's your required sales. I hope it's clear, right? So don't try to by heart anything, okay? The logic is very simple. If I need to earn a profit of 12,000, then first of all I need to earn my fixed cost. And fixed cost is 36,000. After that only I can start earning profit. So totally fixed cost plus profit is nothing but contribution, which means I need to earn a contribution of 48,000. Now To earn a contribution of 48,000, how much is the sales I have to do? Very simple. Contribution divided by contribution percentage will give you sales. So the logic is very simple. Simple mathematical logic. Okay. Chalo. Next, what else you have got after fifth one? What is that he has asked you? Profit. You need to calculate profit at sales of rupees 2 lakhs. So he's asking you to find profit at a sales of rupees 2 lakhs. Very simple. We know classical way of finding profit, correct? Profit is equal to total sales into PV ratio minus fixed cost, correct? I hope this is not surprising because already I've explained you the same equation when I was explaining you the concept of margin of safety in the day 1, right? So this is day 2, obviously you know. So profit, there's a classical way of finding profit like that I've told you. Try to recollect. So classical way of finding profit is nothing but total sales into PV ratio minus fixed cost. So your total sales is how much? Here itself he has given you, which is 2 lakhs. Into PV ratio we have already calculated, which is 40%. Minus fixed cost also we know, which is 36,000. We have calculated for the whole year in the first step, 36,000 per year, correct? So that implies, so 2 lakhs into 40%, which is 80,000 minus 36,000. That implies 44,000 is your answer. 44,000 is the profit at a sales of rupees 2 lakhs. Okay, last one we have margin of safety for 4 and 5 above. Okay, right, sixth one. First of all, MOS for 4. Fourth part of the question. Fourth part of the question, what is your sales here? 1,20,000. So you know how to calculate margin of safety. What is that? Actual expected sales minus BEP sales, correct? That is your margin of safety. What is actual expected sales in 4? 1,20,000 minus break-even point sales is how much? Already we have calculated. Here break-even point in rupees, here it is 90,000. So which means what will be your answer? 30,000. Very simple. We're done with that. Next, seventh one. Sorry, not seventh one, the same one, but margin of safety for 5. So MOS for 5. So that is what he has asked you in the question. So same stuff. What is your actual expected sales in 5? Total sales is 2 lakhs in 5. So 2 lakhs actual expected sales minus your BEP sales is 90,000. That will not change. That implies how much is that? 1,10,000 is the answer. Very simple. Got the point, guys? That's it. We are done with problem number 3. We know all the concepts. There is nothing new to learn from this particular sum except that you know how to calculate requisite sales if profit condition is given. If so much is the profit, how much should be the sales means you know how to calculate. Okay, so there are few things that what we have done. So what we have done in this sum is we have just tried to apply the concepts which we have learned. We have not done something that is dramatic, but still we have learned good things. You got it, guys? I hope this is clear. In case if you don't get clarity, you can just rewind the video, revise the video, and then you can just rewind it and revise it and then move on to the next session. Anyway, guys, chalo, I hope this is clear. Right, so we are done with illustration 3. Okay, now come to illustration 4. Here I'll be doing only the first 2 parts. That should be enough for us. Remaining anyway, it's gonna be similar calculations. So remaining, as one student has asked me, you do it as homework, this part. Okay, this is gift for you. Do it as homework. Okay, the first 2 I'll be doing, the first 2, right? Chalo, anyway, fill in the blanks for each of the following independent situations. Okay, to answer this, I need to create a format. Let's see how I'm going to create the proforma for question number 4. Now see carefully. First column, what I'm going to write is particulars. Next, IAYE, then BYE. Anyway, I'm going to do only 2, correct? Okay, now see how a typical proforma of income statement looks like as per marginal costing. Now this is very important for solving so many other sums also. So listen carefully. First, it should start with selling price per unit. I think selling price per unit is given in this question, right? Reduce variable cost per unit. You'll be getting contribution per unit. Then multiply that with number of units. You'll be getting total contribution. Then from this, you need to reduce fixed cost once you get the total contribution. Then eventually you'll be able to get profit. This is how a typical income statement looks like as per what marginal costing. It's easier to calculate. Don't start with total sales, reduce total cost. I mean total variable cost. No, that will take a lot of time. So this is the easiest way of doing things, and the presentation is much better, and it will not waste your time also in the examination. So that way it is important. Okay, let's put the numbers that is given in the question first. Selling price per unit not available. Variable cost as a percentage of selling price, it is 60%. Still, this is not the number. Variable cost is 60% of selling price, that is there. Number of units sold is 10,000. So here you have units. This is 10,000 given in the question. Marginal contribution is 20,000. That is nothing but total contribution over here. This is 20,000. What else you have got? Fixed cost is 12,000. Okay, this is 12,000. That's it. Okay, now straight away we can calculate profit first. Contribution is 20,000 minus 12,000 is the fixed cost. So which means 8,000 is your profit. This is ready. Okay, now I need to calculate contribution per unit. Total contribution divided by number of units will give you contribution per unit. So 20,000 divided by 10,000 units is equal to 2. 2 will be your contribution per unit. Now, suppose selling price is presumed to be 100%. In that variable cost, it is told in the question that it is 60%. Then contribution should be how much? 40%. And that 40% is 2 rupees. If 40% is 2 rupees, how much should be 60%? How much should be 100%? So simply 2 rupees divided by 40% will give you 5, which is 100%, which means the 60% should be 3. Okay. You got all the numbers. Very simple. You got the point. So if 2 rupees is 40%, then 60% is how much? So simply 2 rupees divided by 40% will directly give you 100%, which is 5. And then you can find the 3 as balancing figure also. Your way. Whichever way you want, you can do it. Okay, it's simple to calculate. Right, so we are done with AYE. Next, we need to calculate what? BYE. So let's have a look into BYE now. Selling price per unit is given, which is 50. Next, variable cost as a percentage of selling price not given. We need to calculate. Number of units sold, 4,000. Okay, this is 4,000. Marginal contribution, 80,000. Okay. Fixed cost not given. Profit or loss, 20,000. Okay, profit or loss is 20,000. Okay. Now tell me one thing. Contribution minus fixed cost is profit, correct? Contribution minus fixed cost is profit. Okay. When contribution is 80,000 and profit is 20,000, what is the difference between these two? 60,000 should be the fixed cost. Why? Because 80,000 minus 60,000 will give you 20,000. Correct? It ho gaya. Now, contribution per unit should be how much? Total contribution is 80,000 divided by number of units is 4,000. Total contribution divided by number of units will give you contribution per unit, which is 20. Which means obviously your variable cost should be 30, which is 50 minus 20. Pretty simple. Are we done with by? Yes. Remaining CEE, DEE and WYE. You do it as homework. In the similar way, same format, you write CEE, put all the numbers that is available, then do the reverse working. You'll be able to get the remaining numbers. Pretty simple. Got the point, guys? Okay. So that's what it's important. See, once you have the right methodology of solving, things will become very simple. That's the beauty of marginal costing actually. It seems to be very difficult, but eventually it's a simple chapter. The more you enjoy marginal costing, the more simpler it will become. The more you try to, what can I say, feel it as difficult, it will become even more difficult. That's a tendency of marginal costing. Okay, the chapter nature is like that. So, okay, we are done with this. Okay, problem number 4. Let's move on. Next we have problem number 5 over here. Okay, so let's have a look into this. The reliable battery company furnishes you the following income information for a financial year. You got particulars, first half and second half. You got sales, first half and second half is given, and you have profit earned, first half and second half is given. From the above, compute the following items assuming that fixed cost remains the same amount in both the periods. Okay. PV ratio, fixed cost, profit or loss where sales are rupees 6,48,000, sales required to earn a profit of 1,08,000. So that is your question. Okay, first you guys read the question, we'll start solving. Read the question, guys. Right, guys, I hope you guys are done with your reading. Have you tried? That's the reason I gave you some time. I hope you guys have tried. Anyway, so if you have tried, it's really good. Shall we? Chalo, now. So you have sales, you have profit earned. From the above, compute the following items. Okay, so let's do it. Question number 5. Okay, first let's prepare the income statement. Okay, now look at the question. Just a second. Yeah. Okay, I'll take the pro forma from the question only. I'll write it same ways. So first we have particulars. Then we have first half. Then we have second half. Okay, as usual, what will be our income statement as per marginal costing in a simple way? So first you'll be having sales minus variable cost. You'll be getting your contribution minus fixed cost. You get your profit. Quite a bit simple, right? Chalo. So that's quite a bit simple. So let's pick up all the information that's given in the question. Sales is given. For the first half, the sales is how much? 8,10,000. Then for second half, the sales is 10,26,000. That's given in the question. Profit earned first half 21,600. Second half 64,800. Okay, that's it. He said fixed cost remains the same and he has asked you to calculate what is the first one. This is the information that he gave you. Okay, the first one that he has asked you to calculate is PV ratio. Now you guys need to tell me how to calculate PV ratio over here. Now try to recollect all the formulas that I gave you. And you guys remember the residual one, the last formula which I gave you. In case if you are not able to calculate PV ratio with any of the formulas, there is a last resort you have to use. As a last resort, you have to use one formula. I've told you that. So what is that? Now see here. Yeah, change in profit divided by. You guys need to recollect. Yep. Change in sales. Got the point? Change in profit divided by change in sales. Let's do that. So what is change in profit? 64,800 minus 21,600. So the change in profit is 43,200 divided by what is change in sales? 10,26,000 minus 8,10,000 comes around 2,16,000, obviously into 100 to get the answer in percentage. So 43,200 divided by 2,16,000 into 100. So how much is going to be your answer? 20% is your PV ratio. This is where understanding things conceptually comes in handy. Now that you know PV ratio is nothing but contribution percentage, it should be relatively easier for you to solve this particular sum. Now very simple, how to calculate this contributions here? Contribution percentage is nothing but PV ratio. So contribution percentage is 20%, which means your sales, which is 8,10,000 into 20% should give you your contribution. 8,10,000, because PV ratio is contribution percentage as a percentage of sales, right? So 8,10,000 into 20%. There you go. That's your contribution. 1,62,000. Correct? Here also 10,26,000 into 20%. You have your contribution. 10,26,000 into 20%. So this is 2,05,200. Okay. Now, so what's gonna be your variable cost? Difference between these two. 8,10,000 minus 1,62,000. Difference between the sales and contribution, which is 6,48,000. Pretty simple. Here also same stuff. 10,26,000 minus 2,05,200. So it comes around 8,20,800. Okay. So there you go. That's your contribution. Now what about fixed cost? Again, it's the difference between your contribution and profit. So contribution is 1,62,000 minus profit is 21,600. So 1,40,400 is your fixed cost for first half. Second half also it's gonna be the same because it is said so in the question. 2,05,200 minus 64,800. So it is 1,40,400. So it's the same stuff. Are you able to understand? Same stuff, exactly the same in both the cases, first half as well as the second half. Got the point, guys? So we're done with it. We're done with the income statement. The whole income statement is filled up. Okay, now let's start answering. We're gonna go to the next one. So first one is done. What is the second one is asked in the question? Second one, what he has asked you to calculate is fixed cost. Did we calculate fixed cost? Of course it is 1,40,400. We have already calculated from the income statement here, this one. Okay, what else? Third one, what did he ask you? Profit or loss where sales are rupees 6,40,000. Very simple, we'll do it the classical way. So when sales is 6,48,000, you need to calculate how much is your profit. So profit is equal to, what is the classical way of doing? Total sales into PV ratio minus fixed cost. This is a classical way of doing things, right? That implies. So what is your total sales, guys? In the third question, profit or loss where sales are 6,48,000. So 6,48,000. Here it is, guys. Okay, 6,48,000. So 6,48,000 into PV ratio kitna re? Just now we have calculated 20%. Here it is, right? Minus fixed cost. Here we have calculated 1,40,400. Here fixed cost should be calculated. I mean should be taken per period. That's very important. So 6,48,000 into 20%, which is 1,29,600 minus 1,40,400. So which means eventually you'll be facing a loss. Minus 1,40,400. So the loss is 10,800. 10,800 loss will be the answer for third question. Got it, guys? Chalo. Now let's move on to fourth one. Sales required to earn a profit of 1,08,000. Same stuff. So you need to calculate required sales. The condition is profit should be how much? 1,08,000. Pretty simple. You guys remember already we have done the same model in the previous problem. Okay. So required sales is equal to required contribution divided by contribution percentage. That implies required contribution is nothing but fixed cost plus required profit, because fixed cost plus profit is nothing but contribution whole divided by contribution percentage is nothing but PV ratio. Correct? That implies, what is your fixed cost, buddy? Just now we have calculated 1,40,400 plus required profit as per the condition of this question 1,08,000 divided by PV ratio we have already calculated in this question, which is 20%. That implies, so 1,40,400 plus 1,08,000, okay, is equal to 2,48,400 divided by 20%. So which comes around 12,42,000. Which comes around how much? 12,42,000. Got it, guys? That's it. Done. Okay, we're done with all the questions of this particular thing. Okay, fourth one is done, third one is done, second one is done, first one is done. Fantastic. Chalo, have a look at this once. We'll move on to the next one. Got it, guys? We started with the income statement, then we have solved eventually slowly, one after the other. 1, 2, 3, and 4. Okay. Look at question number 6. Now this will again be homework for you. Why, sir? Because it is similar to fifth one. Read the question once. I'll give you time. Tell me, is there any difference between fifth illustration and the sixth illustration? Read the question. I'll just give you one more minute. And tell me, do you find any difference? Okay. That's the reason I gave it to you as a homework. Just read it. I'll just give you some 1 minute of time. Just read it. If it is possible, do it now itself. Or you can do it as a homework. In the next class, I'll ask you. Probably, let's see. Or you can do it and below this video, put it in the comment that this is the answer. I'll see the comments. And I'll talk about those students in the next class as well. Okay, because I really want to appreciate students, because when we ask something, students showing love, I really respect you guys and thank you so much. So in the next video, definitely I'll appreciate those students. I'll wait for the comments, I'll see it. Okay, so do it, guys. Done, guys? You guys have tried? I hope you have. Chalo. Let's move on to the next one. Illustration 7. Just a second, guys. Okay. Right, friends. Let's come to illustration 7 now. So Joy Limited, operating at 80% level of activity, furnishes the following information for last year. You've got products A, B, and C. First, you have selling price per unit. Then we have profit as a percentage on selling price, units produced and sold, and then we have fixed cost. During the next year, the variable costs are expected to increase by 10%. There will, however, be no change in fixed cost, selling price, and units to be produced and sold. So everything is going to remain same except for variable cost is going to increase by 10%. The sales potential for each of the products is unlimited. First one. Prepare a statement showing PV ratio, break-even point, margin of safety for the last year and the next year for the company as a whole. This is a keyword. You should be calculating the thing for the company as a whole, not for product A, product B, and product C. Got the point? Next, the second one is the company intends to increase the production of only one of the three products to reach the full capacity level by utilizing the spare capacity available. Because right now it is operating only at 80%. So there is a spare capacity of 20%. Assuming that all the three products take the same machine time, advise with reasons as to which of these three products should be produced so that the overall profitability is maximum. So that is the question. Okay. I'll give you a minute of your time. I want you guys to read this question 3 times, understand it, try to think in your brain how to solve this, and then we'll go for the solution. Okay. Do it, guys. Done with reading, guys? Sure. Let's go for illustration 7 now. Okay, as usual, first we're gonna go with our income statement. With that only we can calculate PBR, BEP, and MOS for the company as a whole. We need to do it for last year as well as next year. That's the kind of work which is going to take time eventually. So let's do that. So first column is going to be particulars. Now I'm trying to answer the first part of the question. That is calculation of PV ratio, break-even point, margin of safety for last year and next year. So particulars, then we have A product, B, C, and then we have a total column as well. Why do we need total column? Because we need to calculate all these things, the so-called PV ratio, break-even point, and margin of safety for the company as a whole. So that's the reason we have the total column as well. Okay, chalo, let's start. So first we have selling price per unit. From this, reduce variable cost per unit. Obviously you'll be getting contribution per unit. You got the point? Then you multiply that with the number of units. Yeah, I'll be getting total contribution. From that you reduce fixed cost. you get your profit. Okay, yeah, simple. Now let's fill up everything, and then eventually once all the filling up stuff is done, we can eventually calculate PV ratio, BEP and margin of safety for the company as a whole. That's what has been asked in the question over here. I gave you time to read that as well, right? Chalo, selling price per unit for A, it is 10. Given in the question, B 12. Given in the question, C 20. Okay, here there is no question of total. You cannot total 10 plus 12 plus 20. Okay, selling price per unit cannot be totaled. Next, variable cost per unit. Is it given? Nope, not given. Okay. Okay, here is the thing. We have a problem over here. Profit is given as a percentage of sales. It's 25%. Okay, there we got the problem, which means we have to redesign this. Chalo, let me redesign them. Profit is given as a percentage of sales. So if I take selling price per unit, it's not gonna work. Okay, chalo, anyway, which means we need to redesign. How? I'll tell you. See here. I'll start with sales minus variable cost in total. You'll be getting contribution in total minus fixed cost in total. You get your profit in total. You can ask me, why did I go for this sort of redesigning of the answer? Because profit is given as a percentage of selling price. You'll understand when I solve it. Okay, coming on to sales. So here it is 10 rupees per unit into how many number of units you have got? 10,000 units. So I need to write total sales figures. So which means it will be 10,000, one additional 0. So it is 1 lakh. Now coming on to B, the selling price is 12 into number of units of B, 15,000. So total sales is going to be 12 into 15,000. So it is 1,80,000. Coming on to C. So C, it is 20 into 5,000. So 20 into 5,000 is equal to 1 lakh. You got it? Now I can write total sales as well, which is 1 lakh plus 1,80,000, 2,80,000 and 1 lakh. So this is 3,80,000. Okay. Right. Chalo, ho gaya. Next, variable cost, not given in the question. Okay, profit is given as a percentage of selling price. So let's do that. What is the percentage of profit over here? 25% for A. 25% into sales is how much? 1 lakh. So which means profit is how much? 25,000. That is the reason I've redesigned everything. Okay. Next, here profit percentage kitna re? 33.33% into what is your sales? 1,80,000. So which means your profit is 1,80,000 into 33.33%, which means 60,000. It will come around 59,999.99. So obviously 60,000. Then next, the profit for C is 20%. So 20% into, so it is 1 lakh is the sale value. So obviously profit will be 20,000. Simple. So total profit will be kitna re? 25,000 plus 60,000 plus 20,000. It comes around 1,05,000. Ho gaya. Okay, what else? Fixed cost is given. Fixed cost is how much for A? 40,000. Copy paste from the question. B 45,000. C 25,000. Okay. Next, what else? I think everything is done. So now contribution minus fixed cost will give you profit, correct? Which means, can I say fixed cost plus profit is nothing but contribution? So which means contribution should be how much over here? 40 plus 25, 65,000. Because only then 65,000 minus 40,000 will give you 25,000. Are you able to get me? So here 60,000 plus 45,000, which means it's around 1,05,000. Okay, 60,000 plus 45,000. So fixed cost plus profit is nothing but contribution. Next, last one, 25,000 plus 20,000, 45,000. So what will be the total contribution for the company as a whole? That also we need to do. 65,000 plus 1,05,000 plus 45,000. 2,15,000. Here it's gonna be 40,000 plus 45,000 plus 25,000. 1,10,000. Okay guys. Chalo, now we can calculate variable cost as a balancing figure. That's also very important. Let's do it. So what is the balancing figure over here? Sales is 1 lakh for A minus contribution is 65,000. The difference should be variable cost, which is 35,000. Next here for B it is 1 lakh 80,000 is sales minus contribution is 1 lakh 5,000. So it comes around 75,000. Okay. Next for C 1 lakh minus contribution is 45,000. 55,000. That is the variable cost. So finally 35,000 plus 75,000 plus 55,000. So 1,65,000 is the total variable cost. Oh yeah. Okay, now that we are done with all the numbers, so everything is ready for the company as a whole. Now let's start calculating. This is for which year? Last year. All the figures are for last year. So let's write the heading last year. So let's calculate everything for the last year. First one. He has asked you PV ratio. PV ratio is nothing but contribution by sales into 100. That implies, what is your contribution for the company as a whole? 2,15,000. So 2,15,000 is the contribution. 2,15,000 divided by sales for the company as a whole. Here it is 3,80,000. 3,80,000 into 100. That implies, so 2,15,000 divided by 3,80,000 into 100. So 56.578. So I can say 56.58% approximately. Okay. Next, second one. What is the second one? Is asked to calculate BEP. Okay, so BEP is nothing but fixed cost divided by PV ratio. You want answer in rupees. Okay. Next, fixed cost is how much we have calculated for the company as a whole. Here it is 1,10,000. So 1,10,000 divided by PV ratio, just now we have calculated 56.58%. That implies 1,10,000 divided by 56.58%. It comes around 1,94,415. See, there will be approximation guys, because if this is, if PV ratio approximation is taken, then automatically there will be approximation when it comes to what? Break even point. So keep that in mind. Okay. Chalo, coming on to the last one, third one. MOS. So what do you mean by MOS? Margin of safety, which is nothing but actual expected sales minus break even point sales. Correct? That implies, what is your actual expected sales, which is nothing but total sales for the company, which is 3,80,000. That is the actual expected sales minus break even point sales. Just now we have calculated over here 1,94,145. Okay, 1,94,145. That implies, so you have 3,80,000 minus 1,94,145. That is equal to 1,85,855. Okay, that's your answer. 1,85,855. So that is your margin of safety. Okay, simple. So now we have calculated PV ratio, break-even point and margin of safety for which year? Last year. Now we need to calculate the same for which year? Next year as well. So let's write the heading as next year. Okay, now what is the problem? Look at the question. During the next year, I'll show it to you over here. So during the next year, the variable costs are expected to increase by how much? 10%. So this is one serious change. Everything else, however, there will be no change in fixed costs, selling prices and units to be produced and sold, which means everything is going to remain what? Same, except there is one change. That is variable cost will increase by 10%. So keeping that in mind, again, we have to recalculate everything. Now that's gonna take hell lot of a time. So let's do the same. So we'll start with particulars as the first column. Then we have A, B, C and of course total. because again we need to calculate PV ratio, break-even point and margin of safety for the company as a whole, but not for last year but for the next year after increase of 10% in variable cost. Chalo, which means obviously your sales is going to be same. So as usual, particulars will be sales minus variable cost. You get contribution minus fixed cost. You get profit. Same stuff, nothing new. Now sales, yeah, we need to copy paste. Here it is. 1 lakh, 1 lakh 80, 1 lakh. 1 lakh, 1 lakh 80, 1 lakh. Okay, because he said, if you see, there will be no change in fixed cost, selling price and units to be produced and sold. So which means this 10,000, 15,000, 5,000 units will be same. The selling price of 10, 12, 20 also will be same because it has been clearly given in the question. Therefore, I've copy pasted. Now from that, I need to reduce variable cost. Now variable cost will change. It will increase by 10%. Let's do that. So what is the old variable cost? 35,000 for A. So 35,000 plus 10%. Here, old variable cost for B, 75,000 and 55,000. 75,000 plus 10%. Here, 55,000 plus 10%. That implies, so 35,000 into, I can directly multiply with 110%. 38,500. Revised variable cost after increase in 10%. Okay. Next, 75,000 into 110%. 82,500. Next, 1 lakh into 110%. Sorry. 55,000 into 110%. 60,500. Okay. So I hope everything is clear. Right guys, chalo. Now let's calculate contribution then. We have increased the variable cost by 10%. Everything else is going to remain what? Same. And let's calculate sales minus variable cost. So 1 lakh minus 38,500. So 61,500. What else? 1 lakh 80,000 minus 82,500. This is 97,500. Next, 1 lakh minus 60,500. 39,500. Okay. From this, I need to reduce fixed cost. Fixed cost will not change. How much is fixed cost? 40, 45, 25. So 40, 45,000, 25,000. I hope I am correct with the figures. So 40, 45,000 and 25,000. That is your fixed cost, right? Now let's calculate profit then. So profit will be how much? 61,500 minus 40,000. 21,500. Next, 97,500 minus 45,000. 52,500. Next, 39,500 minus 25,000. 14,500. Okay, that's your profit. Okay, now we have to total the figures because we need to find everything for the company as a whole. So sales, I think already we have calculated 1 lakh plus 1 lakh 80,000, 2 lakh 80,000 plus 1 lakh, 3 lakh 80,000. Variable cost we need to calculate 38,500 plus 82,500 plus 60,500, 1 lakh 81,500. Next, contribution also we need to calculate 61,500 plus 97,500 plus 39,500, 1 lakh 98,500. Okay, next, fixed cost. It is the same 40, 45, 25. I think here we have calculated 1 lakh 10,000. Okay, last profit 21,500 plus 52,500 plus 14,500. So 88,500. Okay, yeah, right. Okay, now let's calculate the same stuff. We'll start with the first one. PV ratio is equal to contribution by sales into 100. Okay, that implies, so what is your contribution, guys? Here it is. Let me change the ink color, it will be easy for you. Okay, this is contribution 1,98,500 divided by, what is your sales? This one, 3,80,000 into 100, correct? So 1,98,500 divided by 3,80,000 into 100, so 52.24% approximation. Okay, actually it comes around 52.2368, so I've taken approximation as 52.24%. I hope it's okay. Chalo, next. After PVR, PV ratio, what is the next one? Break even point. Fixed cost divided by PV ratio. That implies fixed cost is how much in total? Here it is, 1,10,000. Okay, chalo, let's put that. So 1,10,000 divided by PV ratio, just now we have calculated 52.24%. That implies 1,10,000 divided by 52.24%. So this is 2,10,567. Okay, approximation will be there. Chalta hai. Next, third one. Okay, after that, what is the next one you have got? MOS, margin of safety, is nothing but actual expected sales minus break-even point sales. That is equal to, what is your actual expected sales? What is the actual total sales for the company over here? 3,80,000 minus BP sales. Just now we have calculated 2,10,567. That implies 3,80,000 minus 2,10,567. So 1,69,433. That's your answer. Okay, so with this we are done with PVR, BEP and MOS of next year as well. So last year is done, next year is done. The only difference that we have done is that with respect to last year and next year, the variable cost has got increased by how much? 10%. That's the only difference. Except that everything else is same. Got it, guys? Chalo. Now let's move on to the last part of the question. That is the second part. Let's go with the question once. This one. Okay, so what is that he has asked? The company intends to increase the production of only one of the three products to reach the full capacity level by utilizing the spare capacity available. Okay, so let's calculate the spare capacity first. Okay, so total units produced and sold as of now is equal to A plus B plus C. Right now, how many units of A you are producing and selling? 10,000. How many units of B you are producing and selling? 15,000. How many units of C you are producing and selling? 5,000. All these things are there in the question. That implies, so it is 30,000 as of now. What is that? Units. So right now you are producing and selling 30,000 units. So existing capacity is how much? Existing capacity is 80%, correct? If you look at the question, in the first line it is given. See here, Joy Limited is operating at 80%. So right now their units produced and sold is 10,000 plus 15,000 plus 5,000, correct? That's what I've done here. 10,000 plus 15,000 plus 5,000, which is 30,000 units, which is nothing but 80%. So total capacity 100% will be how much? Very simple. 30,000 units divided by 80% will give you 100%. 37,500. Okay, from this we can calculate spare capacity. That is 20%, which is 7,500 units. Correct? Now in question what he is asking you is, with respect to the 7,500 units, which product you will manufacture such that your overall profitability is maximum? That is the question. Will you manufacture and sell product A or product B or product C with respect to those 7,500 units? That is what has been asked in the question. Okay, how to answer this? Very simple. Calculate contribution per unit for all the three products A, B and C. Whichever product gives you highest contribution per unit, that will be your answer. Very simple. Okay, so whenever you come across these kind of challenges, this is what you got to do. So calculation of, here I'll write the heading, change the ink color. Calculation of contribution per unit. Now which year this is happening? Next year. That is very important, because in next year the variable cost has got changed. So first of all, selling price per unit, it's gonna remain same. How much is selling price per unit? For A it is 10, for B it is 12, for C it is 20. Okay, selling price per unit is going to be the same, minus variable cost per unit. Here you have to be careful. What is the new variable cost of next year? 38,500 for A. So 38,500 for total number of units divided by how many units of A? 10,000. So per unit, what is the variable cost? Variable cost per unit is 38,500 is the total variable cost divided by number of units, which is 10,000. So that is 3.85. Okay, got it. Next, coming on to B. The total variable cost in the next year after increase in 10% is 82,500. 82,500 divided by how many units of B you have? 15,000 units. So what is variable cost per unit? 82,500 divided by 15,000. So 5.5. Okay, variable cost per unit is 5.5. Then what else you have? Last one, C. So when it comes to C, what is the variable cost over here? 60,500. 60. Right, 60,500 divided by how many units of C we have? 5,000 units. 60,500 divided by 5,000. 12.1. Right, done. So now that we have calculated variable cost for the new year, reduce that to calculate contribution per unit. So for A, 10 minus 3.85, 6.15. For B, 12 minus 5.5, 6.5. For C, 20 minus 12.1, 7.9. Okay, yeah, contribution per unit is done. Now tell me, what is the ranking with respect to contribution per unit? First rank is 7.9, second rank is 6.5, third rank is 6.15. So who has got the highest contribution per unit? And that is C, which means you will utilize the spare capacity to manufacture C such that the profit for the company will be what? Maximum. So final answer, conclusion, out of 3 products, okay, that is given in the question, C should be produced so that the overall profitability shall be maximum, as it has got highest contribution per unit. As it has got highest contribution per unit. Got the point? Fantastic. That's it. So that is the question. So the funda is very simple. Whenever you come across a situation where you have been confused with some 3 to 4 products, and then he has asked you which product should be manufactured such that my profit should be maximum, then the answer is very simple. You just go with that particular product whose contribution is high. Whichever product has got highest contribution, that is the product that you have to manufacture such that the profit will be maximum. As simple as that. If there is limiting factor, then the situation is different. What is that? I'll explain you later when I go to limiting factor concept explanation. That is there in your syllabus. Right now, for the moment, the understanding that you should have is, whenever there is a question where you have multiple products and he has asked you which product has to be manufactured such that the profit should be maximum, the answer should be very simple, and that is, what is that? Go for that particular product whose contribution is maximum. and that automatically will ensure that your profitability is maximum. You got the point? That's it. We are done with this. Okay, so in the next class, what we'll be eventually doing is we'll go with problem number 8 and then 9 and then 10. When I go for 10, I think I should see whether you have indifference point or not in your syllabus. If it is there, I'll cover it. Otherwise, I'll not do it. Okay, if indifference point is not there. After that, we'll be covering most important concept, that is marginal costing versus absorption costing. We'll cover it in depth, and then we'll try to solve a problem from your ICA study material itself, so that you'll be able to get some clarity. We will not only cover marginal costing versus absorption costing, we'll also cover the concept of absorption. We'll also cover the concept of product cost and period cost. All these things will be covered. Normally, concept of absorption should be covered in overheads chapter, but we'll cover it here itself. In overheads chapter, we'll directly go with the remaining concepts. There again, I'll not be repeating the concept of absorption. So the agenda for the next class is the balance problems. I think indifference point, I think it's not there for you right now, if I'm not wrong. Okay, so I'll try to check your study material right now. Earlier it was there, but now it's not there. So then we'll be going with marginal costing versus absorption costing, and we'll also go with the concept of absorption, and we'll also go with this particular thing, concept of, what is that, product cost and period cost. So that is what I've seen in your study material right now. Okay, so these are all the things. Okay, yeah, multi-product break-even analysis also we'll solve that sum. We'll do that. So whatever the concept that we have got, we'll try to do it. Graphical presentation of break-even chart, we have already seen it. Okay, nothing much over there. Right, margin of safety we have seen. Okay, okay, I think we have done this decently well. Okay, right guys, so I'll try to go through your study material one more time, and I'll try. So limiting factor is there, this will be covered here, it is there, and we'll try to solve this sum as well based on limiting factor. Okay, so hereafter we'll solve some problems from your study material. That would be better in the next session. So that will be our agenda right now. Okay, chalo. So thank you so much guys. I hope you guys have enjoyed this particular video. In the next session, as I told you, all the important concepts of marginal costing will be covered, and we'll be finishing off this particular chapter as well. That is our agenda. Okay, in the next session. So right now, thank you guys. We'll wind up the session over here. In the next session, we'll continue as usual. If you love the session, definitely comment it and like it. And in the next video, I'll talk about you guys, and then I'll move on to the next session. Okay, so thank you so much guys. This is PK sir signing off. Let's continue in the next session with our costing CA inter revision marathon. Thank you.